Passive Pockets is presented by Equity Trust. Today, we're diving into the future of fiat currency and the global financial reset with insights every passive investor should hear. From gold to crypto, inflation to de-dollarization, the financial world is shifting fast and investors need to understand what's coming. If the US dollar is replaced or reset, what happens to your investments? And how can LPs prepare for a possible new monetary era? Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Jim Pfeiffer, and today I'm pleased to be joined by Russell Gray, the Main Street capitalist and founder of Raising Capitalist Foundation. He's going to talk about fiat currency, financial resets, and how LPs can prepare and navigate for what's coming. Let's get to it. Russ, welcome, and thank you for coming back on the show. We really appreciate you.
No, I'm happy to be here, and congratulations on your new affiliation with BiggerPockets. That's exciting.
Yes, thank you very much. So the reason I had you on the show today, besides just, I really enjoy the conversations that we have, is I was in the crowd at the Best Ever conference last month when you were presenting, and you talked a little bit. You didn't dig too deep into it, but fiat currency and a financial reset and how you see that happening. So I want to focus today on just that one topic and really dive into it, as plain as we can make it. You're great at making things understandable. Let's just dive in. What is a financial reset and what is the fiat currency system that we're in?
The first thing to just understand is what capital is, what money is, what currency is, and what credit is. And I think a lot of people conflate currency and money. And so I'm going to start at the top, which is capital. And capital is the creation of goods and services. When you actually go grow something, harvest something, mine something, build something, provide some service, you have created something of real value. It doesn't matter what you denominate it in. When you take the value of that and store it in some vehicle so that you can use that value later. For example, if we were both in the sandwich making business and I made a sandwich for you, but you said, well, I really don't want to eat that sandwich today, then you might want to store the sandwich in a refrigerator and it would preserve the value of that sandwich until you were ready to eat it. That's a job of money. So money takes the product, in this case, a sandwich, and converts it into something that will hold its value until the person who's holding it is ready to consume that value or exchange it really to someone else for a new sandwich, if you will. For many thousands of years in human history, gold was the vehicle used as money. And J.P. Morgan, not the bank, but the man, famously said, gold is money, everything else is credit. And he did that in a testimony before Congress. And so the next thing is currency. And currency, we think of as Federal Reserve notes or fiat currency. These are these pieces of paper. Well, when they were first introduced, they were claims on money. So if you go back and not too long ago, you could find dollar bills that look just like a regular dollar bill that we see today. But instead of saying Federal Reserve note, which, as you know, a note is an IOU, it said silver certificate. And it was redeemable to bearer on demand for $1 of silver. And everybody's talking about April 2nd coming up because Trump is supposed to announce his tariffs. But April 2nd is also, I think it was 1792, the anniversary of the Coinage Act. And that's when the US dollar was established. And the US dollar was a specific amount of silver. And then, of course, gold was another specific amount. It was $20 was an amount of gold. And so the dollar wasn't, it was like a gallon. In other words, it was a unit of measure. So if you could take, say, a gallon of milk, and we're all dairy farmers and we live in a community. And so our medium of exchange is milk. It's a crappy medium of exchange, right? Or money because it goes bad. But let's just say you've got this magic milk that never goes bad. And so you're running around with this gallon and you say, well, how much for you to give me a new suit? And you go, that'll be 5 gallons. And so I bring you 5 gallons of milk. And somebody else says, well, I want to have a steak dinner. What's that? Well, that's going to be a half a gallon. Well, somebody else says, well, I want to buy a new car. That's going to be 20 gallons. And so you just get used to denominating your exchange in this currency of gallons. But we all know that it represents a gallon of milk. Well, what happens after a while is nobody ever opens the gallons. Somebody hands you a gallon, now it's empty. They hand you the container, but it's empty. It doesn't have any milk in it. And you accept it because you've never bothered to use it. You just always pass these things around. Well, that's what happened. Our pieces of paper that used to represent or contain a certain amount of gold or silver quit containing that certain amount of gold and silver, and we started just denominating or calling money dollars, but dollars was only a unit of measure. So that was the shift. So you got capital, which is a creation of goods and services. You have money, which is something real that holds the value of that production over time until someone is ready to use it. Then you have currency, which is a medium of exchange. It used to be currency and money were one and the same, but we separated them. And the way I explain that is if I had a 1964 quarter in one hand and a 1965 quarter in the other hand, in 1965, both would buy a gallon of gasoline. But today, only one will. And if you ask a young person which one and why, they don't know. Do you know?
I do, but it's because you gave this example in the last podcast, and I absolutely love this example, and I wanted you to give it, so I'm so glad you brought it up. Continue. This really crystallizes a lot for me. You know, it's like the toga example when they say an ounce of gold in the olden days would buy a toga and it will buy a suit today, right? So it's a similar analogy.
Yeah. So the 1964 quarter contains silver, which is real money. So as the dollar has lost its purchasing power, it takes more dollars to buy the same amount of silver. So that 1964 quarter is worth about $3 or $4 today, which will still buy a gallon of gas. But the 1965 quarter is a zinc-plated copper coin, which is only worth about 6 cents in terms of metal. And so its face value, or the 25 cents that is the denomination, is worth more. And that would only buy maybe 1/20th of a gallon of gas, depending on where you're buying gasoline, right? And so when you separate the money from the currency, it's a problem. So if you were to say, go back in time to 1965 and take a roll of quarters, which is 40 quarters or $10, and stick it in your sock drawer, and you pulled it out 50 years later, 60 years later, it would still buy 40 gallons of gas. But if you took a $10 bill, a $10 Federal Reserve note, and you went to buy, you could buy maybe 3 or 4 gallons of gas. So you've lost all that purchasing power. And so capital is a creation of goods and services. It's the gasoline, it's the sandwich, it's the gallon of milk. Money is something that preserves the value of that capital until you're ready to use it. Currency is what you actually exchange in. And then credit is a derivative of currency. And everything in our system today is credit. It's all credit. And so that's why the dollar bill says Federal Reserve note. A note is an IOU. Problem is you have to ask yourself, well, what do they owe you? Well, you can't redeem it. They don't owe you anything. It's just, it's a note that you can never cash in. It's like if I just wrote you a piece of paper and said, you know, this is good for whatever, but it isn't good for anything because you can never redeem it.
Explain credit then. So, you know, when I go and make a charge on my credit card, right, I'm effectively creating more money or currency. Can you talk about what credit is and how that effectively is created?
I don't want to pretend to be an expert in kind of the technical inner workings of the banking system. My buddy George Gammon is much better at it than I am. The way I look at it is credit is taking future purchasing power and bringing it into the present. And so when you look at the things that affect prices, everybody always talks about inflation, which is more currency being printed than goods and services being presented. So a simple way to explain that would be if we had one bottle of water and 10 people. And so everybody has, say, 10 $1 bills, and you're dying of thirst. And so if you were to start bidding at $1, pretty soon somebody's going to bid up to $10 to get that one and only bottle of water. And the person who's going to get it is the person who bids up to $10 the fastest. So now, if you just simply add 100, everybody has 100 $1 bills, and you start the bidding at $1, where's the bid going to end? $100, right? And the first person who gets here is going to get it. That's called hyperinflation. You added more currency without more goods and services. Now, in that same environment, if you were to produce more and you had 10 water bottles and you had 10 potential consumers and you started the bidding at $1, the price is only going to be $1 because the first person would put down $1 and nobody would bid. And if they bid at $1, they would have another another bottle, and everybody would get filled at $1. So even though you have excess currency, you don't have inflation. Does that make sense? So but when you add credit, now I have the ability to go into the future and pull purchasing power in from the future to bid on the present. And this is why when you add financing to make something affordable, it becomes more expensive. So if you want a college education, before when you had to pay cash, it cost you $10,000 a year. As soon as they made it affordable by adding financing, it costs $100,000 a year. You used to be able to buy a house for $10,000 or $20,000. Then they added 30-year financing, and you could pull 30 years of future earnings into the present. You bid the thing up to $300,000 or $400,000. Right? Same thing with cars. Same thing with anything. So credit is the ability to pull earnings from the future into the present. And what you're doing is kicking the can down the road. Anybody who's ever gone into debt knows that. It feels good in the moment because you're able to spend the future today and enjoy it today. But down the road, you have less purchasing power because the repayment and the interest on that debt gets kicked down the road. Well, now here we are in the United States of America. We took over in Bretton Woods and became the world's reserve currency in 1945, I believe it was. Right after we won World War II, we had 20 tons of gold. We had a positive balance sheet. We're the world's largest creditor. We had the biggest manufacturing base and especially a huge competitive edge because the rest of the world had been completely devastated by the war and we weren't. And so we were, the big dog and we took over the world. Well, we quickly started printing more dollars than we had gold because the world could redeem their dollars for gold from 1945 at Bretton Woods all the way up until 1971 when Nixon broke the gold standard. And if you look at all the charts, that's when all the inflation started because once the currency was decoupled from money, you could print as much currency as you wanted. You could create as much credit as you wanted. The whole system became debt. And at some point, going back to what I was saying, you're using the future to pay for the present. If you wait long enough, the future becomes now, and there's nothing left. And that's what I call the event horizon, like in a black hole, right? When you cross over, and, that's a downward spiral. And when you have nearly $1 trillion a year going out on the interest on the national debt, and you're already running a deficit, now you're borrowing to pay debt service. That's how a syndicator becomes a Ponzi operator. That's how countries go completely broke. And when you spend $1 and you get less than $1 in GDP gain, you become unsustainable. And so we're there. And so we have to fix it. We have to fix it fast.
In episode 160 from March of 2024, Russ, you were on and you gave a great history from Bretton Woods all the way to the present. So for listeners that want to hear the full, it's a fantastic episode. I encourage you to go back to that one. But what I want to talk about for the rest of the time we have is where are we going from here, right? We're in this system, and you've explained it fantastically how the inflation happens and the difference between money and currency. And it seems like that was separated in the 70s, right? When we went off the gold standard, where before that, money and currency were pretty much the same thing. And now they're definitely not. So where do we go from here? What's going to happen? And, I know that global and government monetary systems, they undergo major changes every long period of time, right? Whatever that is. But when you're in the middle of it, when you're our age, and pretty much, we've always been on this same fiat, where money and currency are separated, we can't imagine anything else, right? It seems like it'd be this huge thing if something changed. So where do you see this going?
Yeah, the world went full fiat in 1971 when the world's reserve currency, the US dollar, broke from gold. And so for anybody who wasn't an adult in 1971 and aware, it's the only environment you've ever known. But if you look at it historically, it's this giant anomaly. The question is how do we get out of this? And there's all kinds of efforts being made to do it. Internationally, the first attempt to get away from the dollar was the euro, but they just went fiat. And so it didn't really work. And so the next attempt has been this alliance of the BRICS, Brazil, Russia, India, China, South Africa, and all of the companies that piled on. And this movement really began in earnest after the GFC, Great Financial Crisis in 2008. And that's when I really started studying it in depth. And it's because China, who was holding at the time $2 trillion in U.S. Treasuries, saw how much dollars we were printing. The Fed took its balance sheet from 800 billion to 4.5 trillion. And they came over here and said, hey, you're going to dilute the value of all these dollars that you owe us. And you need to be a better steward of this currency. So the United States is, yeah, whatever. And so China got together with Russia and they started signing these bilateral trade agreements where they would begin to trade with each other and not use the dollar. And then they continued over the last 15 years to grow that alliance. As you may recall, right after Donald Trump got elected, before he was even inaugurated, he cautioned to the BRICS. He says, listen, if you guys try to upend the U.S. dollar as a world's reserve currency, I will slap 100% tariffs on you and lock you completely out of this wonderful U.S. economy. And people say, well, the BRICS thing wasn't really a threat. Well, then why did Donald Trump defend it so vigorously? He said that on 2 separate occasions. Part of what the suspicion for people like me that pay attention felt like what the BRICS people were doing is you need to, if you're going to issue a currency, and they were going to create a currency that they would share like a euro, but it was going to be backed partially by gold and partially by maybe other commodities, but certainly by these large economies, much, much, much bigger than the euro and even bigger than the United States. To me, it was always been a real threat. And I think, had Donald Trump not been elected, I think it maybe would have been a bigger threat. So you have that. At the kind of the Main Street level, if you will, you have this introduction of Bitcoin. Bitcoin is an attempt to decentralize away from fiat currencies and go into something that cannot be printed into oblivion. If you believe what everybody says about Bitcoin, that it's limited to only 21 million coins ever, and nobody can print it, nobody can manipulate it. It is completely independent. It's a decentralized currency as opposed to something printed by a central bank or a central bank digital currency. It's a currency that cannot be controlled, which would be very deflationary, by the way, which is really what sound money would do. And so that's gotten some traction. And now you've got an administration here and others around the world that are talking about forming strategic Bitcoin reserves. So I don't know, will we go in that direction? I don't know. Then you've got people like Judy Shelton that Trump originally nominated to be on the Federal Reserve Board in Trump 1.0. She may circle back in Trump 2.0. I think there's a wrestling match going on right now between Jerome Powell and Donald Trump, who's going to be the more dominant economic force. And I think right now Trump is winning. It used to be, and you're a financial guy, you read the news, and every day of the Fed this and the Fed that and the Fed this and the Fed that. And then Jerome Powell comes out and says, I'm lowering interest rates, and interest rates go up. And everybody's like, well, I don't understand. Well, the Federal Reserve is like a one-trick pony, and it's monetary policy. But the Biden administration really was aggressively using fiscal policy and spending to try to stimulate the economy. And now, as Elon Musk has dug in, we've seen a lot of that, and a lot of that economic strength and employment strength that was purported to be in the Biden administration was largely the product of a lot of printed money, a lot of money kind of flowing through the system. Trump is coming in, he's doing something very different. And so for the first 6 or 7 weeks of the Trump administration, 10-year Treasury rates were actually going down, but they were going up prior. And so it wasn't the Fed, it was the fiscal policy of the administration. And if you really look at it, the administration, the government, Federal Reserve is not the government, it's a private cartel of banks, but the government actually has more control over what goes on. They control spending, they control trade policy, they control foreign policy. So they have a lot more control over what goes on. And so what you're seeing is a attempt by the Trump administration to grab control of the economic levers from the Fed and not allow the Fed to inflate. And we'll see. I mean, inflation is going to be the thing. If Trump falls in the pit, it's going to be because he loses control of inflation. If he loses control of inflation, the wave he rode into office, the mandate he thinks he has, his ability to get anything done will disappear at the midterms. That's what I talked about at Best Ever, is like what's going on right now and how is he going to try to thread this needle in. And it's been a fascinating study. I just did a presentation on it last night. I'm going to speak on it again tomorrow morning.
That's where we are now. It's impossible, I guess, to know where we're going. But, it seems like, the U.S., everyone has to use the dollar or is the dollar is the focus. So how does that change in the future? And, I know the BRICS are everyone's trying to move away from the dollar. How do they do that? And how do we defend it? And what does that look like? Are people going to go back to gold? Are they going to really go to Bitcoin? Is that a legitimate long-term store of value? I'm just not sure. And I know this isn't a question you can answer, but I guess we're speculating here, right? Like, what does the future hold if it's not the dollar?
Well, the easy answer, which would be a horrible answer, would be the Federal Reserve begins to issue a central bank digital currency. And then they have complete control in a closed system. It would be horrible for freedom. It would be horrible for privacy.
Can you talk about why? Because some people think central bank digital currency, well, everything's digital now anyway, so it wouldn't be any different. But that's not what we're talking about.
No, you wouldn't have pieces of paper. You wouldn't have the ability to pay cash. Everything would be monitored. Everything would be tracked. They would literally have the ability to choke you off. You remember the old movie Total Recall, the first one with Arnold Schwarzenegger?
Yeah.
Yeah. And so on Mars, the guy that controlled the oxygen controlled everybody. If he didn't like what you did, he would shut your oxygen off. Well, that's what the kind of power the central bank digital currency would give whoever controlled it. They'd have the ability to literally choke you off because it would be impossible to do business, to purchase anything that you need. Cash. I mean, I guess you could go to barter, but that would be it, right? It'd be very, very difficult. So, but that's the easiest thing to do. And so I think I believe Trump said it wouldn't happen. I sat on a panel with Danielle DiMartino Booth, who knows Jerome Powell. She goes, well, as long as he's in that seat, it's not going to happen. I asked her, well, what happens when he's not in that seat? And she goes, that's a good point. So, it's something that everybody who cares about freedom and privacy and autonomy needs to pay attention to. The challenge in getting off the dollar that everybody faces, and if you ever listen to Brent Johnson, who talks about the milkshake theory, is you have to understand what gives the dollar its value. First is legal tender laws. If you pull out a greenback from your wallet and look at it, it says this note is legal tender for all debts, public and private. Number one, if you have to pay taxes, you have to pay them in dollars, which means you have to buy dollars. So, if you do your saving in gold, if you do your saving in silver, if you do your savings in Canadian currency or euros or whatever, at some point when you want to pay your taxes, you're going to have to buy dollars. That creates demand. If there is dollar denominated debt out there, if you have mortgages or you've borrowed money from the banking system in any way, shape, or form, whether it's here domestically or around the world, you've got to pay back in dollars. And so at some point, you're going to have to bid on those dollars. And then, of course, if you want to buy anything in the United States, whatever we manufacture, whatever we export, that creates demand for dollars. That's why when a country produces a lot and exports a lot, it makes their currency strong because people have to buy their currency in order to buy their products, right? That's what happens. Part of what Donald Trump is working to do is repatriate a lot of manufacturing, reduce our trade deficit, and bring it up to where we become a net exporter of energy and we start exporting food and mining and all kinds of things that he's done just in the last 30 days. And so if that happens, it'll make the dollar actually stronger. And so I think as investors, we just have to think about, kind of like what that means. We think about the dollar constantly falling, which means real estate and debt on real estate is always a good bet. When you have a strong dollar, a dollar that gets stronger over time, that's more challenging because the dollars that you earn become harder. And it's going to be harder on the rest of the world than it will be on us because now it becomes very expensive to buy a dollar. So the rest of the world would prefer us to have a weaker dollar. And then they just want to have a weaker dollar. Jim Rickards writes about, I got a book behind me, but if you haven't read it, Currency Wars. And he talks about beggar thy neighbor. And that is where it's a race to the bottom. Everybody is trying to lower their currency so that they have a advantage in trade. It makes their goods and services cheaper. So the currency thing matters. So I don't think anybody's saying that we're going to replace the dollar in the near term. Although I just read an article today that I think the CBO just came out and said we could have a default on treasuries within the next several months by September. I don't think that's going to happen. But, they say those things. I just say what I'm saying is you can't have $36 or $38 trillion of debt, $1 trillion a year of interest service. You can't have this baby boomer demographic with Medicare and Social Security and all these people leaving the workforce. You can't have that if you don't have a productive economy. And we have financialized our economy. It was one of the points that I was making when I was at Best Ever. And when you have a financialized economy, the challenge is it works as long as somebody out there is producing goods and services. And the way I explain it to people is sandwiches. I think I talked about sandwiches earlier, but if we had a little economy where there's 30 people and they're all making sandwiches, and you make roast beef and I make tuna and somebody else makes, grilled cheese or whatever. And you get up every day or I get up every day and I'm eating tuna and I get tired of eating tuna. I need to find somebody that makes roast beef, but I don't know how to find you. So one of the 30 people goes, well, I can make a market. So tell you what, I'm going to stop making sandwiches and I'll be in the business of printing coupons that are claims on these sandwiches. And I'll run around and be the person who makes these markets. And I'll help the guy who has grilled cheese find the guy who has roast beef. Well, that all works because you've got 29 people out of 30 that are eating sandwiches. You got 29 of them making sandwiches. But after a while, the 29 people look at the one guy who's not making sandwiches anymore, goes, that looks like more fun than making all these sandwiches every day. So I want to get in the coupon business. And so pretty soon now you got 10 people in the coupon business and only 20 making sandwiches. Well, you don't have to be a rocket scientist to figure out when you get more coupons chasing sandwiches and less sandwiches being made, you're going to have more expensive sandwiches. And at some point, if everybody keeps leaving the productive side of the economy, the sandwich making business, and gets into the financial side of economy, the coupon on sandwich business, claims on sandwiches, pretty soon there's not enough goods and services and too many claims on wealth. Wall Street is about trading claims on wealth. Main Street is about doing real work. And we need to get back to where we produce real goods and services in this country so we have abundance. It'll put downward pressure on prices. It'll make our currency more valuable. It'll make our people richer, but it's going to be a shift. And I think the bigger concern that I would have for Main Street right now isn't that we're going to come off the dollar standard. I think if you have some gold, if you have some silver, maybe if you have some Bitcoin, you're going to be hedged against that if something like that were to happen. I think the bigger concern is how the economy is going to change and how the interest rates and how the market will work as we transition from being a financialized economy, very dependent upon government spending, to a privatized economy that's productive. Anytime you make a shift, I would say overall it's going to be a good shift. It's going to be a good thing. But any transition, when you change the rules of the game for people, everybody playing the game is only ever known it one way, from financial planners to policymakers to bankers to investors to entrepreneurs. We only know how to play the game one way. But J.D. Vance just came out and gave a speech. He goes, look, we're trying to unravel 40 years of failed economic policy that globalized or financialized this economy. And we're dependent upon other countries to make essential things that we need. We're going to change that. And to make that transition, we're going to go through some pain. Scott Bessent, the Treasury Secretary, came out and goes, we're going to go through some detox. We're very addicted to cheap money being spent by the government. We're going to privatize this economy. So we're going to go through a detox period. And I just think Main Street needs to be prepared for that. And I hope be patient and work through it, because I think on the back end, it's actually going to be very, very good. But nobody's had the courage to take us through that transition. And right now we're trying to get through it, not just get through it, but get through it in 2 years. Because if history is past its prologue, typically a sitting administration loses the House at the halfway point. Now, I think Trump is going to go for a supermajority, but history says he's already beaten history once by getting reelected. So he might beat history, but I think the reason you see so much aggression from the Trump administration is he knows he's got 2 years to ride this red wave and the thin margin he has in the House and Senate to get his agenda in. And he's pushing as hard as humanly possible to do it. And when you are that aggressive, it is going to be chaotic. And it is going to be, I think people are going to get kind of caught up and not recognize. What's the old saying Helen Keller said? A bend in the road isn't the end of the road unless you fail to make the turn.
That's right.
I think there's going to be some shifting going on, and people are like, I don't understand this. It's never happened like this before.
So what do, investors, so you said a lot of things there that, we're perking up in investors' ears. One is, debt, when the dollar is strengthening, debt becomes, I don't know, problematic, or, because a lot of people are like, you want debt, you want leverage, because in an inflationary environment, when you have debt and you pay it back 10 years from now, it's less, right? You're basically inflating away your debt. So, the government also has a ton of debt. So they are also incentivized to inflate away that debt as a way to pay it down.
Well, that's one way to pay it down, but not the only way to pay it down. And that's not the methodology. That's always been the methodology. I don't think that's a game plan going forward. And that's one of those shifts I'm talking about.
How would we pay down the debt in this big shift?
There's a couple things that have already been floated. Obviously, if you have a bunch of debt on your balance sheet and you don't have the ability to print money out of thin air or inflate your debt away, how would you do it?
I guess I would sell assets and get rid of the debt that way, right? Pay it down.
Yeah, you'd sell assets. You'd try to increase your productivity and earn more money so that the debt became a smaller percentage of your earning power. Okay, so we've already seen the Trump administration come in and go through the government and say, okay, we're going to get rid of all wasteful spending. That's going on. Second thing is we're going to look at these idle assets like these office buildings and we're going to dump them. The other thing is we're going to try to create new products that we can sell. Oh, hey, we got a great country. We can sell passports for $5 million each. And if we sell, I don't know what he said, 1 million of them or something, whatever the number was, he goes, if we do this, we can pay off the debt with that. Listen to the things that he's saying and watch what he's doing. If we repatriate a lot of manufacturing, and I chronicled, I think yesterday in the presentation I did, something like $2+ trillion of investment that's been committed to the United States just in the last 60 days. And so if you get a bunch of foreign investment coming in, and then that creates additional profits and productivity here in the United States. That's money that gets put into our infrastructure. With Taiwan Semiconductor, for example, is going to put $100 billion into Arizona. Well, that's coming from Taiwan, but it's going into Arizona. So you're going to see a lot of things that are common sense if you're a business person that politicians haven't done in 40 years. That's what's happening. And so I think you're going to continue to see that. Now, is the Bitcoin strategic reserve a play on that? Might be. If he's sitting on, I think, 200,000 Bitcoins that they have confiscated. And then if they were, say, for example, to revalue gold, which is something they've talked about doing, and then use the proceeds from that revaluation to purchase Bitcoin. And then with the idea that the rest of the world would get on the Bitcoin train, then as the rest of the world follows the United States lead, it's kind of a pump and dump, right? Then they can sell those coins and pay off the debt. So I think all of these things are in play. To me, you just got to pay attention to it and try to figure out where the shifts are going to be, where the disruptions are going to be. Every one of those is going to create a problem and an opportunity because both are always present in the same circumstance. So it isn't a matter of things being good or bad. It's whether you're good or bad and understand what's happening. And so I think that is where, in the macro picture, is what I spend my time doing is trying to educate people. I can't give them an answer. I don't know what the answer is. I'm just saying, watch these things and let's talk about it. And maybe collectively we can figure it out. But it's very, very new.
I'm always looking for answers and it's hard to find them. And this next question is not answerable. I understand that. But, maybe we can inch in the right direction here. What, as a passive investor, especially in syndications, what strategies should we look at and adopt, or what should we be thinking about doing with our money during this? It's just an uncertain time. Like I keep saying it, that the one thing I've heard from the Beige book was, they broke a record for saying uncertainty 45 times. And I don't know if I got that from you or somebody else, but somebody said that, I think, at the BEC. And I was like, okay, so we're in an uncertain time. So what do we do?
One of the advantages that Main Street investors have, real estate investors have, is they already have something very fundamental right. And they don't buy low and sell high. They're not day trading. I call that, if you look at the acronym, buy low, sell high trading, BLSHT. You can make a word out of that if you want to. And then you can compare that to buying the productivity of others. And there's an acronym there too. Real estate investors instinctively focus on cash flow, which is real wealth. Wall Street investors focus on buy low, sell high. And they don't even care about earnings. They don't pay any attention to earnings. Dividends are such a low priority. And so these PE ratios get completely out of hand. Now, you look at a fundamental stock investor like a guy like Warren Buffett, and he's looking at these PE ratios, price to earning ratios, which are the equivalent of cap rates, right? I mean, the way a real estate investor would think about it. I mean, how many apartment buildings you're going to buy with a cap rate of like 0.5 point or 1 point? Going to be tough. So a guy like Warren Buffett is like, I'm out. And he's sitting on, I don't know how many hundreds of billions of dollars of cash waiting for it to correct because he buys income and he can't buy income at a decent rate. The other reason it's important is because stock prices are based on comparative samples. And that means the equity is very fake. They call stocks equities. And so if you have, say, 100 million shares of Apple computer floating around the marketplace, and somebody buys 1,000 shares of them and pays $200, then when you mark your book to market at the end of the day, all 100 million shares are deemed to be worth $200 because one guy bought 1,000 shares.
It seems to be the way you said that, it's like how they value a home is by comps, but how they value a commercial building is by the income it produces. And it seems like that's what you're saying.
That's 100% what I'm saying. So real estate investors, especially apartment investors, already understand you can't value an apartment building with 100 units that are empty, not trading, based on one guy renting one unit, right? No mortgage guy is going to go, oh yeah, you got 100 units here. One guy rented it for $1,000. So based on comps, every other unit's cash flowing at $1,000. Nobody would do that. So a real estate investor almost doesn't even understand the way these Wall Street guys think, but they don't think that. And the problem is housing is often like that too. Right? It's not based on income. That's why you'll see houses, you can't get a house to cash flow because homeowners will bid way more than what reasonable rent would be. But commercial real estate gives you some real opportunities. So I think keep doing, what you're doing as a real estate investor, look for markets. And what I would focus on right now, and this is what I taught last night on the Investor Mentoring Club, is look at where all this capital investment is going. The United Arab Emirates just pledged $1.4 trillion over the next 10 years. That's $140 billion a year. Taiwan Semiconductor just pledged $100 billion to come into Arizona, right? And so these countries, Meta, Facebook, Apple, $500 billion going into Texas and I think one other state. They tell you where they're going. So set some Google alerts, follow these companies, follow these announcements, and go as far up the beginning of the sequence of events as you can. Don't wait until it shows up. Get there early. I had a chance many years ago, as you know, with the real estate guys, we would do these annual cruises. I'm sitting on this cruise, and this was like one of the very, very first ones before we had all our own entertainment. And I'm sitting next to this woman, and I said, where are you from? And she goes, well, I'm from Colorado. I said, oh, really? Well, what do you do? She goes, I take cruises. I'm like, oh, that's so interesting. How did you get to a place in life where you just get to take cruises? She goes, do you really want to know? I said, I really want to know. And she says, well, I heard that the Denver Broncos were going to be moving their stadium. And I went out to where they were going to put the stadium and I bought all of the available vacant land that I could find. And today I operate parking lots. Right? It was that simple. It was that simple. And so to me, I think that you just have to look where this money is going to go and say, well, I'm not going to invest in the companies. I'm not that smart. But I know when these companies come into town and they build factories, those factories are going to create jobs. And then companies are going to co-locate. So you say, well, if Taiwan Semiconductor, for example, puts in a big manufacturing plant, what other kind of companies have to be near them? What companies are going to pop up? What kind of buildings do they need? What kind of demographic are they going to hire? And then where are they going to need housing? There's a big copper mine up in Arizona, northeast of Phoenix. If we loosen up, and the Trump administration signed an executive order on March 20th, opening up mining, saying that we've overregulated mining. We've made our mining uncompetitive. We used to be a producer of strategic minerals and metals, and we quit being a world leader in that because we overregulated. And Vance came out and said, we're going to get rid of these regulations and open things up so we can log again, so we can fish again, so we can mine again. Right? Now, you may, as an environmentalist, go, oh, that's terrible. Well, that may be true. But as an investor, you look at it and go, well, that's what's happening. So whether you like it for environmental concerns or not is beside the point. If you're going to invest, then you have to look, this is going to happen. And so as these industries start up, then you have to look at the housing and the secondary and tertiary businesses that are going to pop up, right? It's like these old mining towns. If you go watch those old Western movies, the guy that Levi Strauss, right? He wasn't a gold miner, but he made more money than any of them because they all came to town to mine the gold and he sold them the jeans. And he was the guy that made money. So I think look for those kind of opportunities as a real estate investor. And then the one thing I'd say is to be careful of, if you remember back in the shale boom, boom. In North Dakota, they had the Bakken. Remember the Bakken?
Yeah.
And so everybody's like, oh, yeah, I got to go do real estate. Nobody wanted to live there. And you have to look at the ability of the marketplace to react. And so you don't want to get caught in what I call the lag. And the lag is you get a bunch of people who come in to, in this case, drill for oil, and there's no place to live. And so they're living in their truck, they're living in trailers, people are bringing trailers in and dropping them somewhere. And then real estate investors get all excited and they come in and they bid up. But there's land for days. And at some point the supply is going to catch up. And if you're a long-term buy and hold investor and you're buying a temporary phenomenon, you might be on the wrong end of it. The people who made money there were the people who went in and either bought an existing property and then brought it up to snuff and rent, and then sold it to somebody who wanted to buy and hold, or say an apartment developer going to come in, I'm going to develop it and then sell it. The flippers made money. So just make sure you understand, real estate 101 is still the same, supply and demand, and what is the ability of the supply to expand, and just if there's a shortage, is what's underneath that shortage. At some point, shortages correct by creating supply, unless you've got some type of artificial barrier. You go to Manhattan or you go to Silicon Valley, there's no place to expand inventory. So the prices can only go up. But if you don't have that natural barrier, then you just got to be careful if you go long term. So but again, these are things that everyday investors, understand. And if you're a passive investor, meaning you're investing in somebody else's syndication, as a syndicator, this is the type of investment thesis you need to be explaining to your potential investors. And as an investor, you need to still understand what you're investing in. You need to understand the basic supply and demand, what is driving the demand, and what is either hindering or facilitating supply, and will that dynamic you're buying today still exist 5 years, 10 years from now? Because real estate is a longer term commitment to a market. So you have to not only make sure that you have your financing, your capital stack figured out, but you also need to make sure you really understand the economic environment that you're investing in. But I think a lot of sleepy markets that have been ignored are going to be restored. If you learned a lot in Trump 1.0 about, say, opportunity zones. And if you remember the whole opportunity zone thing?
Yeah.
He understood that if you wanted to mitigate your capital gain and transfer your capital gain into an opportunity zone and make your tax go away, you have to leave the capital in the market for 10 years, right? That's because he's a real estate guy and he understands. I can't give you bonus depreciation for 1 year and then you'll suck your capital out. I need you to commit to this market for 10 years if we're really going to turn it around. We haven't seen his tax code yet, but I think you're going to see more of that kind of stuff coming as he's working to get foreign capital and domestic capital reallocated into privatizing the economy and goosing manufacturing. And if you just follow those macro trends and go geographically where they lead, you're probably going to find, like the woman in Colorado, you're probably going to find some opportunity.
I mean, that's amazing stuff. I have one more quick question. We are running out of time here, but in the last time we spoke, you talked about income is equity. So can you just real quickly give us your perspective on, building true wealth through these income producing investments and why that's so important?
If you own a stream of income and the income increases, let's just use simple multiples. I won't use cap rates. I'll just use gross rent multipliers. If you have a property selling for 10 times its yield or its gross rent, so you've got an apartment building that's cash flowing $1 million a year, gross rents, and it's selling for $10 million, let's say, and you increase the income to 1.2, then you now have equity of 12. You created $2 million of equity on $200,000 of income. So income is equity. Once you understand that basic concept, now, of course, cap rates matter and interest rates matter. It's really, NOI is more important than gross rents. And of course, anybody that's gone through the rise of insurance rates and, the changes in interest rates, and of course, what's going on with property taxes in some jurisdictions, you realize that you have to focus on NOI. But the point is that if you increase NOI on a property, which is net operating income, you're going to increase the equity in that property, all things being equal. And the thing that is equal is what interest rates are. I think where everybody in the multifamily space got kind of screwed is I don't think anybody expected the aggression of the interest rates. And I heard people argue, oh, well, interest rates are only, 6-7%. Historically, they're very low. Yeah, but it's not that. It's a percent of change. You know, when Volcker in the 80s took us from 8 or 9% up to 18, it was like 2.5 times. He doubled plus a little bit. But when you go from 0.25, 25 basis points to 5.25, that's like a 20x. The percentage of change was unseen, and it blew up a lot of balance sheets, including unfortunately, a lot of multifamily investors. Hopefully the worst of that is over now, and we'll see. But you have to be careful with that.
We're hoping. Well, listen, this was fantastic. We always appreciate you coming on the show. It's just great information. If people want to follow you or learn more about what you're doing, what's the best way they can do that?
I think the easiest way is just send an email to follow at Russell Gray, RussellGray.com. Follow at russellgray.com. I'll send you an email back and show you how to follow me on social media. Let you know when I launch my new show, Main Street Capitalist, and everything else I'm involved in. If you don't like what I send you, you can always unsubscribe.
Awesome. Well, I look forward to that. And again, thank you so much for being on the podcast. We appreciate you.
Thank you, Jim.
That wraps up our conversations on fiat currency, the future of the US dollar, and how LPs can prepare. A big thank you, as always, to Russell Gray for coming on the show and sharing his knowledge and expertise. If you found this episode helpful, don't forget to like, subscribe, and leave a comment. For more tools and education on passive investing, visit PassivePockets.com and sign up for our 7-day free trial. Thanks for tuning in, and as always, happy investing.